Okay, so I want to review credit sales with you really quickly. I know we've already talked about these quite a bit, but they're going to be very important when it comes to this next section where we talk about bad debts, accounts receivable, and the allowance for uncollectible accounts. Okay, so remember, credit sales is when we transfer goods or services to a customer, but they're going to pay us cash in the future, right? We're anticipating, we are entitled to cash in the future from them. This is what creates that that asset account, that accounts receivable account, right? So when this happens, at the time of the sale, we're going to record a debit to accounts receivable to increase it. And we're going to record a credit to revenue, service revenue, sales revenue, whatever kind of revenue it is, to increase that as well. So let's look at an example real quick. And I know we looked at examples of these earlier, but we can afford to look at another one. So here, let's say that on March 1st, company provides services to a customer for $500. The customer doesn't pay cash at the time of service, but instead promises to pay $500 by March 31st. Okay, remember, pay attention to your dates, because if there are sales discounts and allowances involved, you may need to know how many days have transpired between the sale and the collection of cash, right? So here we're going to debit accounts receivable by $500 to increase it, and we are going to credit service revenue for the same amount to increase it. We can see here that the $500 increase to service revenue is a $500 increase to net income, which in turn flows to the balance sheet and becomes a $500 increase to retained earnings, which increases stockholders' equity. We see that we have a $500 increase to assets, $500 increase to equity. Our accounting equation is still in balance. We are good to go. Also, you will notice debits equal credits. We're always happy when that happens because it means we are on the right track. So let's talk about when we collect the money from the customer. Okay, so let's say we collect $500 from the customer. Well, you're going to debit cash because we're trying to increase an asset here. We're going to increase it by $500. We're also going to decrease that receivable asset because they no longer owe us that money, right? So you'll notice no impact on the income statement. There's no revenues, no expenses, no net income earned here because we already recognized the revenue earlier on when we provided the service. Here, we've got a net zero impact. We increase cash by $500, that's an asset. We decrease accounts receivable by $500, that's also an asset. Net zero impact on your accounting equation. So let's talk about the allowance method. This is what GAAP requires us to do. So GAAP requires us to account for uncollectible accounts using the allowance method. Uncollectible accounts basically mean these are accounts that we feel like we're not going to get the money for. Whatever reason, we're not going to collect the money. We've done everything we can, and we're not going to collect the money on it. That's what an uncollectible account is. GAAP, or generally accepted accounting principles, requires that we use an allowance method. The allowance method is a way of estimating the amount of current accounts receivable that will not be collected. Okay. We report this estimate as a contra asset to its accounts receivable, right? So recall, contra asset account basically is sitting there. It's attached to your asset account. It holds the opposite normal balance. So in this instance, it's a contra asset. It's going to hold a normal credit balance. Okay. They kind of sit there and reduce the value of the asset. Recall, with assets, we have to use the historical cost principle. So since accounts receivable is an asset, we're going to leave it on the books at its historical cost. We create this contra asset account to help us reduce that so that we can show a net book value, right? A net value on our balance sheet of accounts receivable. So remember that. That's going to be very important. You're probably going to have a conceptual question on your test about how do we present accounts receivable. It gets presented at its net value, okay? So under the allowance method, we report AR at the net amount expected to be collected. We say accounts receivable, comma, net, or net accounts receivable, net book value accounts receivable. It will let you know on the balance sheet that it is a net amount. Okay. So the next thing we got to talk about is applying the allowance method. So the allowance method can be somewhat confusing. So if you do have questions about this, please don't hesitate to reach out to me and ask. You will be tested over allowance method. Okay. So at the end of the initial year, you need to establish an allowance, and you do this by estimating your future uncollectible accounts. Okay? The way that we estimate that is with our ending accounts receivable balance. During the next year, you're going to write off actual bad debt as uncollectible. Okay? Please note, actual write-offs probably going to differ from the estimate that you made the previous year, okay? And we'll get to that. Then at the end of the next year, you're going to estimate future uncollectible accounts again, okay? Doesn't make a lot of sense right now, but we will go through an example here. So let's say at the end of 2024, Kimsey is owed $20 million from customers, and they estimate that 30% will not be collected, okay? The calculation for estimated future bad debts is $20 million, the ending accounts receivable, times the 30% that we're estimating won't be collected. That gives us $6 million that we believe will not be collected, okay? So we're going to go ahead and write that off to expense, okay? So bad debt expense, debit it, it's an expense. We're going to increase that expense by $6 million, okay? We are not going to hit the AR account yet. What we are going to hit is what we call the allowance for uncollectible accounts, that contra asset account. We're going to hit it for the same amount, okay? Remember, the credit to the allowance account increases allowance, and it decreases the accounts receivable account on our balance sheet. This is what gives us that net value on our balance sheet. So we report the allowance for uncollectible accounts in the asset section of the balance sheet, but remember, it represents a reduction in the AR account, okay? The difference between total accounts receivable and allowance for uncollectible accounts is your net AR, your net accounts receivable. So the way you'll see it on your balance sheet would be accounts receivable less allowance for doubtful accounts or allowance for uncollectible accounts, and then it will give you your accounts receivable net, okay? This is just kind of a timeline of what's happening. So here in the current year, 2024, we see we made $50 million in credit sales. During the year, we collected $30 million, leaving us with $20 million uncollected at the end of the year. We made an estimate on that ending balance, that $20 million. And we said 30% of this probably not going to get collected. So the estimate right here becomes our new balance in the allowance account, $6 million uncollectible, leaving 14 to be collected. So our net AR is 14 million. It's going to show on our balance sheet as accounts receivable less the allowance, net accounts receivable. Okay, if you have any questions about that, please don't hesitate to ask. Okay, here is just an example of how the T accounts work, right? Just remember, the allowance account is a contra asset account. It has a normal credit balance. It is not a liability. It is still an asset type account. It's just a contra asset, okay? Here we can see this 80 reduces the value of our ending balance in accounts receivable. So we actually have on our balance sheet a net value of $720 million in accounts receivable, okay? So when it becomes clear to us, when we have exhausted all efforts to collect from a customer, and it becomes abundantly clear that we are no longer going to be able to collect that customer's account, we are going to write that account off. We're going to write it off directly, okay? What this does, and know this, because you will be asked conceptual questions about this on your exam. What does a write-off do? It reduces the balance of accounts receivable, okay? The write-off reduces accounts receivable. We're taking it directly out of the AR because they no longer owe us that. It's going to reduce the balance of the contra asset account, okay? That allowance for uncollectible accounts also gets reduced, okay? Typically, you're going to do this in the subsidiary ledgers, writing off the individual account, but you can see it flows up to that general ledger control account, okay? So just remember these first two bullets right here are incredibly important conceptually, that when you write something off during the period, it's going to reduce the balance of the AR, and it's going to reduce the balance of the contra asset account. It's the same concept as getting rid of a piece of equipment, right? If we sell the equipment and we don't get the accumulated depreciation off of our books, then we've overstated or understated somewhere on our financial statements. This is the same thing. When we get rid of the asset, we have to get rid of the contra asset that is associated with that asset. Otherwise, you throw your accounting equation out of balance. So let's look at a write-off example very quickly here. So February 23rd, based on information from a former patient, Kimsey believes it is unlikely the patient will pay his account of $4,000. The entry below writes off a specific account. We're going to debit that allowance for uncollectible accounts. Recall, this is a contra asset account, so a debit will decrease that value. Then we're going to credit the AR. They no longer owe us that money, right? We don't expect to collect it, so that AR gets reduced as well. Okay, so notice that overall, the write-off of that specific AR has no effect on the total amounts reported in the balance sheet or the income statement. Okay, the common mistake is that bad debt expense is reported when an uncollectible account is written off. That's not the case. That's what we call direct write-off method. We do not use it in accrual accounting. Okay, we only, and this is going to be incredibly important, this is another concept you've got to understand, and it will help you answer the computational questions as well. We only increase the bad debt expense at the end of the year when we make a new estimate. So the adjustment that you make to your allowance account becomes your bad debt expense. Okay, we'll talk about that when we go over an example. So I'm going to stop the video here. Next video we'll talk about types of or different ways that we can estimate the bad debt in the AR account.